most of our large FMCG companies are barely able to do 2-3% volume growth. They're flat, sometimes it's down. IT services, again, because of various global issues, not growing. So, in the here and now for the listed market, is earnings growth becoming a real problem?
It is. If you look at the tone of earnings that have come out so far for the March quarter, or the likelihood of earnings in the coming quarter, it's just not going to be great. Okay. And look, if there is a sentiment problem globally because of the uncertainty around tariffs, that percolates to India as well. So corporate sentiment, who is going to set up, commit large capex in this environment? Very few people will want to do that. They'll want to wait and see how these things develop globally. Consumer sentiment is impacted similarly because of the headlines that you read on TV. Oh, if you're an IT employee, are you expecting a big bonus this year? Perhaps, maybe you dilute your expectation, right? Yeah. Which then feeds into your consumption patterns and you become a little bit more cautious. So the Indian economy will feel part of that shock. We'll feel less of a shock than the rest of the world, but we will feel that impact nonetheless. Okay.
But that's the global part of the shock that's kind of percolating through. What about domestic? We were supposed to be a very resilient domestic economy. Then why is there sudden concern about local earnings, domestic earnings as well? So
if you take a, let's say, 10-year historical view, on an index level basis, large cap index, we've never actually delivered dollar earnings faster than EM. So this assumption that, India will have a beta to EM on earnings, it's never actually played out in the last 15 years. So the question I get from a lot of my investors, why am I then paying this multiple premium if you've never actually delivered growth? It goes back to everything we've discussed originally, is because there is an assumption of longer growth in India. Right, that you will get this growth for the next 15 years and therefore the valuation is still justified on a DCF, whereas in other countries you may still be looking at a 2-3 year growth period.
So instead of bursts of sharp growth,
exactly,
this is, higher for longer.
Higher for longer, a duration of growth. Okay. Therefore, to go back to your question, how do you make money in this market is by being patient. If you think that...
Everybody who came in after COVID in the market, please listen to this. It's all about patience. Yes. Please continue.
So, because again, to your point, to take it seriously, right? After COVID, people have made a lot of money, right? Because there've been this huge mid-cap rally. The growth was we were printing nominal GDP growth of 25%, which showed up in earnings when, the equity market straight-lined it and put a multiple on it and all that. That is not how equity investing works. Because I'm looking at more of a duration of growth than a premium to growth, the way you make money in this market is buy at a right price. If you can get a good quality company at reasonable valuations, sit tight, good, well-executed companies in India will deliver compounding returns over time. This is not necessarily true for most countries, but it is true for India.
This is very interesting. So instead of forever searching for the burst of 9% and hit the headlines, which we people in the news love to do, we love our headlines, right? Instead of that, maybe compounding 6.5%, maybe 7% for a prolonged period can lead to prosperity. That's what you're saying.
Yes. Be patient. Don't try to find the next multi-bagger. I mean, if you can, please go ahead, right? Success rates on that are actually lower than people expect it to be. Everybody believes that they are the one that has spotted this multi-bagger well. But it's easier to find large compounding companies, invest, be patient, you'll do well.
So, what would the advice be for investors who are looking at this market for the next sort of 3-year perspective, if not longer? How should they look at their portfolios?
So, again, quality and large cap, right? Okay. Because what has happened is even though several smaller stocks and mid caps have come off post the recent correction, they have not come off enough. So, if I were to do a very simple mathematical analysis, Surabhi, and say which company today is back to 2019 P's. Not even say, I don't even say I'm greedy and I want them cheap or I want them, to fit a DCF or something. I think which company has given up its COVID premiums, X financials, that set is still very narrow. So despite the correction, I have not getting stuff at reasonable valuation. Today, with whatever is going on in the monetary policy and the RBI turning accommodative, the outlook, let's say from a 2-year or 3-year view on financials is still reasonable and they are still available to me at multiples that make sense. Okay. So any India portfolio needs to start off in a large cap mindset with a allocation to financials. The other themes we like power because the power sector is tightening. There's a lot of changes happening with the prevalence of solar. We think the battery world is very interesting because I was skeptical of it 3 years ago and it won't work. Now it makes economic sense to set up batteries in the country. We've liked cement for a while because, it was undershooting and now it's catching up. Real estate should do well, as we spoke of. But the only challenge there is we need real estate which is more mass market rather than the...
And rather than the 20 CR apartments selling in 6 hours.
I think 20 CR also nowadays is...
Now it's history. That's true,
That's
actually.
right.
Yeah.
But yes,
Yeah.
So you need that kind of exposure. Within the consumer space, we think companies that are taking initiative, not necessarily only defending their margins, but which are stepping out and saying, here's some promotions, here's my sales effort, here's a discount for consumers, providing value to the consumer. See, the Indian consumer is not dead. I think the Indian consumer is just looking for value. So if companies take the initiative, they should get their volumes back.